So this right here is the historical delinquency rate of all consumer loans. Okay. So these are the type of loans that you're looking at when it comes to SoFi, right? You can see here that we are at an almost at an all-time low of default rates, because people who get consumer personal loans are not exactly the greatest creditors. Okay. Most people, they turn to personal loans because they're in a hard up position where something happened in their personal life that they have to deal with. And especially people that are like, especially considering if they're getting loans at like 5, 6, 7 years, if you look at the total amortization, how much money they would end up paying, like if they literally just, kept paying all the way throughout the loan, it would be crazy to have that much interest go out the door. Most smart people, especially people with high FICO scores and high incomes, would not go the personal loan route. The minute they saw a 12%, like APR, they throw that shit right in the trash. I've gotten plenty of SoFi offers in my mail because I actually had a SoFi mortgage 2-3 years ago, and believe it or not, that was actually good. They made the process very easy. It was seamless. I didn't have to deal with too many things. Like the entire closing process was amazing. So I do think the company has something in terms of customer service, but they're chasing growth. And what I don't like is when a company chases growth and starts to cut corners. That's bad. So yeah, just that's the reason why I'm a little bit iffy on these guys. And you can see that.
So I want to,
yeah, go ahead. Sorry.
I feel like there's like 6 points. I want to slowly address them, or
Okay.
at least, to some degree. So, one, first of all, I think that the point that you said that, I know that you're not accusing SoFi of being shady, but I think that we should scratch that off the record entirely, that maybe our FICO scores might not be real or something along these lines, because if you look at our competitors, they are all doing the same thing. Very close rates, very close delinquency rates, also with bank charters. Look at Lending Club, for example. They charge higher interest rates than we do and still hold up a very good credit score. And both Lending Club and SoFi both have fully chartered banks. So obviously we're being regulated at the highest level. And lastly, we are also going after they are noticing that the two biggest purchases that people are doing with our personal loans is debt consolidation. And secondly, they're also doing solar loans. So then people can get increases on their house. Now, whenever you look at our actual, annual incomes for these people that get loans, I think Sean said it in the chat. There's a difference between high income earners and wealthy people. The truth is that as people make more and more money over time, they spend more and more money over time. They still need access to capital the same way anyone else would. I mean, obviously their default rates are lower and these sorts of things, but I think SoFi is showing that.
Guys, unfortunately, if you are a wealthy person, you have more access to capital than anyone else in the world. Not to mention, most people that are wealthy have assets that they can use as collateral to get amazing loan rates. I'm telling you, the only.
But I'm not saying they are wealthy.
Yeah,
I'm saying
right.
I think they make a lot. Well,
even like I said, even people who are going to have additional income, they're not going to say, let me sacrifice 12% of it to borrow this. And trust me, if they have high incomes, they have multiple sources where they can reach into to get, to get credit. Yeah, go ahead. Sorry,
I was just going to say, so there must be some sort of like, I think if you say that, then you are saying that what SoFi is putting on their books is cooked in some way, like as if they're not saying the truth.
I'm not saying they're cooking the books by any means. What I'm saying is they are doing business based on what's current right now, what's today, right? They're not necessarily looking at the bad economic times that are coming. Or actually, believe it or not, I think they are. That's one of the reasons why they're increasing they're trying to get as much depositor cash as possible so that this way their balance sheet can be as healthy as possible. So if you guys notice, SoFi offers one of the highest APRs on a savings account. Why? Because they're trying to raise as much capital because that's how banks work, right? They take money and they lend it out, and they lend it out at a higher rate. Well, guess what? These guys are lending it out at 12%. They're borrowing at 3%, right? From the consumer. So that's one of the reasons why they're pushing to get their balance sheet as like rigid and as strong as possible, because there could be a wave of defaults or coming in the future. So these delinquency rates are the thing that I would say people have to watch out for. Like I said, I'm not saying SoFi is bad by any means, but their business model is not made for bad times. Open Door is the same situation. Open Door has a really good business model, but it's built for good times. The strongest companies are not built for good times; they're built for bad times, as Palantir would say. Except Palantir hasn't necessarily proven that. Just to be honest and fair, that's one of the
Kris
things
is just a bear for everything. Kris is just short everything. Is like
I'm not.
I have a quick question. And you said you were a SoFi member at one point. Do you have the app? Do you look at it every now and then?
No, I don't. I only had their mortgage product. Do
you think there is something to be said that they have behavioral data within the app? They have direct deposit data. They have other types of data in SoFi Relay where they track every asset that one of their users has. Do you think that they would be more agile if push comes to shove, like something bad happens?
Dude, if you lose your job, no matter how your behavior was a year ago, is not going to help. Right now, the Fed is pushing people into a really bad situation. That's the key. When the economics go south, how are they going to manage? A lot of this is going to depend on how Anthony Noto navigates this downturn. And if they're able to survive, they could actually come out ahead at the end of it. The question is, as you guys being investors, do you guys trust this company enough to put your capital and say, you know what? I think this guy can navigate this downturn. And this way I can see that exponential return in the future. But once again, personal loans, in my opinion, are not a great place to be.
So, Kris, I'm listening to everything you're saying, and it does make sense. I guess I just have two questions. Number one, how is what SoFi is doing different from what every single other bank is doing as a result of the macro? In other words, if all financial institutions are taking on riskier bets because the interest rates from the Fed are higher, then is SoFi doing anything specific that is out of the norm? Like, I understand they're taking riskier bets. And then number two, I'd love for you to sort of like tackle both. Number two is
well, before you go to the next one, because I'm terrible with keeping up with multiple questions. So other banks are not doing personal loans at the level that these guys are, where majority of their revenue and income is coming from this specific segment, right? If you look at JP Morgan, you look at the Wells Fargos, you look at these big banks, they have way more diversified business, right? The problem is the concentration risk that is being posed to SoFi with just having so many personal loans. It'd be one thing if personal loans only made up, like, let's say 10, 20% of their overall business, but this is getting to the point where it's becoming so much. And if you look at anyone in the personal space, right, the personal loan space, everyone's been slaughtered. Look at Upstart, look at the lending company. There is not a single personal consumer loan company that has done well over the last 2 years. And this is during good times. This is during a good economy. Imagine what's going to happen during a bad economy.
So that's a great answer. And it brings me to my second question, which is, on that chart, we just saw credit cards, and credit cards is a very small offering from an origination perspective compared to personal loans. Are we saying that, is the common conversation here that saying, okay, if credit cards are being offered to 640s, therefore personal loans are also being offered to 640s? Is that like the
not necessarily? Not necessarily.
Is there a world where credit cards is more risky of an offering than personal loans is? To which point,
they're both unsecured debt. The thing with credit card, especially when it comes to high net worth, high income people, the reason why they use credit cards as opposed to, let's say, personal loans is because credit cards, you literally get some level of benefit from using it, right? So it's literally, you do it, you get a % off, whatever. The credit card companies make money on not just on the interest, because they're believe it or not, they make, especially companies like American Express, they're going to make money on the fees that they charge the merchants for processing the transaction. With personal loans, it's not as simple as that. Personal loans are way more risky. And even credit card debt, believe it or not, is super risky. But credit cards are like, if you have, like, let's say a borrower for credit cards, that's like a contract that you have for 5 years. That's not good. These personal loans are extended periods of time. So once again, I would say that I don't know because I haven't necessarily dug too far into what the credit quality of their users are. But based on the averages that I'm seeing that's posted in their earnings, it doesn't make sense. That's all I'm saying. People who have high income and high FICO scores do not get personal loans, or at least I don't know any people that do that. I trust me, and you guys could do your own survey. Say, hey, listen, guys, if you are a high net worth individual, high income individual, would you get a personal loan at a 12% APR?
Right. I think look, I also brought this up a second ago, but also like I said, Lending Club and all these people are also putting up similar results of large growth in their lending their personal loan business. However, they're also really increasing their expected loan losses. So is SoFi. We even put up our loan losses, I think, this quarter by 60%. But even then, it's a small fraction of what we're actually doing in overall business.
And the other thing I would like to just add to that, what Tannor said, is I guess I'd love to see the data, because this is talking about new originations in these periods of time. But how does that stack up against the originations that they had in previous periods? So, for example, let's say, if they are taking on bad debt, let's say, or taking on low FICO scores in 2022, what percentage of the total loans that they have, or total credit card or personal loans, is that, right? If they ramped it up in 2022 and it's a large percentage, then that's something to be, much more cautious of than if the majority was in good economic times with great creditors. And then this is just a small fraction compared to that, if that makes any sense.
Yeah, that's something that you can actually see, because the total volume of personal loans has gone up. How much? Look it up. You can see it. Look at the personal loans in 2021 versus what it is today, and you're going to see a huge increase, right? So just saying, just take a look, guys.
Bro, if Galileo goes to the moon, we really don't got to worry about
your
this
mic.
shit. So, I was just kidding. I was saying if Galileo takes off, it's going to be the biggest thing ever.
Listen, guys, there's one rule that I try to follow. Right now, they're trading under book, right? If they had such a great business, everything, hedge funds, institutional funds, everyone and their mother would be buying the shit out of these guys, especially if it's trading under book. The problem is people don't have confidence in the book value, right? It's one thing to say this product is worth $1, right? And then you know that, hey, it's actually not worth $1. It's probably worth 50 cents. So on paper, it looks like there might be, their book value is it's undervalued based on its book value. But trust me, Wall Street would not be giving it so much grief if it wasn't for their, suspicion. I don't want to say suspicion, but their hesitation. Also, you got the likes of Warren Buffett. Why wouldn't he just come in and just literally buy up everything?
He can't own a bank. But so that is the real.
Wait, hold on. Would you just say Warren Buffett can't own a bank?
Yeah, he can't own.
Doesn't he have Wells Fargo?
No, but I'm saying he could. You're telling me he can't buy into SoFi?
No, he can only own 10% of a bank.
Right, but he can actually still buy, right?
Yeah, but why would he wouldn't buy $400 million of a company?
No, but you're right. But he would put a little bit of money. If he believed in the business, he would put money into it, right?
I don't think so, no. I think he only plays in the largest blue chips because it wouldn't make a material difference to
Dude, this guy buys furniture companies. He buys furniture companies.
But the whole... So I'll send you a clip after, but he talks about how there's really only 50 companies that he will trade going forward, because they're just... If he was to buy small caps or medium caps, they just wouldn't make a difference fundamentally to his business.
All right.
He also doesn't believe in Tesla.
Bank, so
and also other people too, other funds also. Maybe Warren Buffett is probably the worst example to give because he's so big and he could probably throw his weight around. But you should see the institutions. If the institutions are starting to buy up SoFi, that's when I would say it'd be a good time to get in.
Chris,
what do you think look at about Vanguard, BlackRock? A lot of big institutions.
Okay, so one other thing I just want to point out real quick. When it comes to Vanguard, BlackRock, and these guys buy for ETFs that they already have. Like this company is probably in one or two of their indexes. So even though it looks like BlackRock is buying, it's not like BlackRock's like institution funds are buying. It's listen, it's part of their index. Yeah.
So if the ETF is buying while the market is capitulating, that means they're adding to their positions. So the market is selling off generally, so they should also be selling off their positions in SoFi. They're adding to those positions while the market is down quarter over quarter.
Yeah, but that's what I'm saying. New ETFs come along all the time. Also, competitors go down in price, right?
Mhm.
And other things come up. So yeah, they're always fluctuating. There's buys and sells. So what I'm saying is, don't rely on the ETF like, oh, there, look, BlackRock bought some shares today, and as the example of, oh, this means that the institutionals are getting all in on SoFi. No, they're always rebalancing their purchases and their sales.
But don't you
So
think if Vanguard, let's say, puts SoFi into a new ETF that is still bullish, that they do think that that's a good material choice for maybe one of their fintech ETFs or something along these lines?
Not really, because all they're doing is just giving you exposure based on like based on a product that they create. If they will create any sort of ETF, even if it's like the most garbage ETF possible, right? In an industry, like let's say you want a hyper specific ETF where you're investing in a very small segment, they will create that because there is a market for it, right? Where some people want exposure to it. So I would, like I said, I would not consider the purchases of BlackRock and some of these Vanguards as the catalyst for, oh my God, institutions are buying in. The way that I would say is private equity, hedge funds, if those guys are buying in, that's when you know that, hey, listen, this is something to definitely look at.
So Kris, do you think they are a candidate for a reverse split if they stay under 5, given everything?
I don't know, dude. It's all going to be up to Noto. I think right now the best thing that they're doing, the smartest move that they're doing, is raising as much money as possible via direct deposits. Direct deposit, like me right now, I have TD Bank as my direct deposit. There's probably $60,000 sitting in my savings account that they're probably lending out at way higher rates than they're giving me, right? But the thing is, it's one of those things that just anytime I get a paycheck, it just gets dumped into my savings account, like part of it. So these are the kinds of things that like SoFi is hoping for, where they can take that extra liquidity that's being provided by depositors, right, and make sure that their balance sheets are strong. Because what's going to happen is if, let's say, things go south and people start withdrawing their money and they don't have enough money, then they hit by a bank run, it's over for the company, right? So they need to be as liquid as possible and have as strong of a balance sheet as possible going into this downturn. My guesstimate is that Noto would probably end up doing a reverse split, but reverse splits are bad. Like that's not a confidence. That doesn't give too much confidence in a company, by the way. If someone's talking about doing a reverse split, not to mention anyone who's got options is definitely not going to be happy.
I know you have some like issues with their main profit engine right now, but what do you think about the whole thesis of what SoFi is trying to do long term? Because I mean, okay, let's say like worst case scenario, they go through all this stuff 2023 and they get hit by a lot of stuff. Like if they get through that, where do you see like SoFi going? Do you think that their business model that they're trying to set up is worth it? Like the all-in-one stop shop?
I mean, it's all about execution at that point, right? Where you're going to need a CEO who can execute. One of the key, I wouldn't say mistakes, but one of the key problems with SoFi right now is their operational costs are crazy, right? Look at how much money they're spending on sales, marketing, and all that stuff. So the question is Anthony Noto going to be able to cut costs where it's necessary and get through the tough times? Because that's the key right now. If you look at every company on Wall Street, I mean, on the market right now, especially on the tech side, Google does not need to lay off 13,000 people. Facebook does not need to lay off 10,000 people, but they all know, hey, this is the time to be, tighten the belts, get capital efficient, get capital conscious, because there will be a time where things go downhill and we need to make sure that we are well capitalized, we have well stocked funds, and we're not blowing money on things that are not going to generate a return. So I would say it's going to all be on Anthony Noto. And believe it or not, I think the guy is great. The one thing I'll give Anthony Noto that I don't see other CEOs doing, this dude has been a nonstop buyer in the company, right? That's confidence. You look at these other CEOs, bro, they're all selling. They're literally like, Anthony Noto could have sold. He could have sold so much, but instead he actually used his personal money and bought more and more shares of SoFi. So I personally would not short SoFi, not at all. I mean, when a CEO is buying shares, that's not good. I mean, that's not good for the shorts. So I would never do that. Yeah, and like I said, I like the guy overall. I think I was listening to the speeches that Amit sent me. Me and the wife were listening as I was driving from Utah to Vegas. I think the guy's phenomenal. Like in terms of just, he's a great orator. You know, he gave an example of his days at West Point when he was on their football team, the injuries he took. So this guy is an experienced operator. The question is he going to be able to navigate this downturn and see SoFi through the end? I do think that there is a possibility, but I'm one of those types of people that even though I go to Vegas, I don't go to the slot machines. I go to the craps tables. You know, I don't like the things.
So Kris,
is it because you go to the crap tables because you're crap at slots?
No, it's because slots have a ton of house edge, and craps is one of the lowest house edges in the possible. So there you go. So you
Kris,
don't know anything about gambling.
Kris, just 2 questions for you. I'd love to get your take on. Look, man, first of all, thanks for hopping on, because I really love the contrarian takes. And I think that, you know, I'm not going to discount that, like from an emotional perspective. I think it's a solid take, and it's I think one of the most real bear cases that we've heard on this pod so far. I think 2 things that I'm curious about is, number one, since we talked about RIFs, a reduction in force, do you think that SoFi should do one, number one, and do you think that they will do one? And also the second question is, what is the thing on the balance sheet or on their income statement that we should be looking at in the next earnings to see if these, you know, delinquencies are rising, or if their plan is working or not working? Like, what's that number we should be paying attention to?
I would say delinquency rates, right?
Just the delinquency rate alone?
Delinquency rates are the canary in the coal mine for financial health in this business. If you're lending out money that people are not paying back, clear as day, you got a problem. And if the economy is going south, people are losing their jobs, that's not a unimaginable scenario, right? The question is, how are they going to manage it? And the problem right now with them is that so much of their balance sheet is not securitized. Pull that up on the thing on the Twitter, on the tweet.
But do you think securitized?
Bro, I can't stop hearing titter now every time someone says this thing.
Okay, so I want a clarification. Are you saying that we're still holding a lot of our loans on our balance sheet, or that they're not secured loans?
No, that they're holding them on the balance sheet. They're
sure.
not,
okay.
So personal loans are not secured loans. Those are unsecured loans, right? Which means that anyone in bankruptcy can discharge them. They're gone. There's no collateral backing it, right? So that's the other thing. Like, I'm sorry, pull up one of the, I don't know which slide, because I posted a whole bunch of on there.
Bro, you posted so much bearish shit today. Wait, where is it? This one.
Listen, all you SoFi bulls, I got you a good deal, man. Okay, so here's their loans, right? Loans at fair value. You can see September 30th, 2022, and December 31st. So this is 6 months. Look at that personal loan growth right there, right? Now look at how much of it is securitized personal loans. Only 97 million. They have $6.8 billion on their balance sheet right now, right?
Right.
So, you know, that is a huge risk. For people to understand securitization, because I think that's one of the things that might help. What SoFi does is goes outside, finds consumers for their loan products, takes those loans, which are in the form of an IOU, puts them all together, bundles it all up, and sells it to private investors, right? Whether they be hedge funds, institutions, pension funds, so on and so forth, right? The problem is, in order for them to do that, they have to have, to get these loans and put them on their balance sheet. They have to lend the money out. And eventually, once they get enough of them, they can start to securitize them. The problem is, if you look at how much of their securitized personal loans were 6 months ago, it was 234 million. Now it's literally $97 million of personal loans that are securitized, right? That are literally sitting on the balance sheet. The rest, they're just holding a whole bunch of IOUs right now. So if the delinquency rates go up, who suffers? SoFi does, not the people who are holding well, technically there aren't any that much securitized products out there. So
how bad could the delinquency rates actually get though?
Well,
very bad. Very bad.
Look at the historical rates. That's the first thing I posted real quick. Go ahead, Amit, put that up.
So
right there. So if you look at the average, right? And this is going back almost 40, 50, 60 years. We are at the lowest point in 2022 in terms of delinquency rates. If we just return to historical averages around, let's say 3.5%, 4%, 5%, and all that stuff, all of those loans are sitting on SoFi's balance sheet, that's not good. That's really bad.
If the interest rates climb faster than the delinquency rates, then we pay for the losses.
You're already charging 12.25%. Like,
yeah, but
how much
credit cards charge 25%. I mean, if there's no cap to delinquency rates, then there's no cap to interest rates.
Yeah, but that goes right counter to your point. If you raise interest rates, high net worth individuals and people with wealthy individuals are less likely to take on the loan then. Like, if you're telling me a person who's like making $200,000 a year and you tell them, hey, listen, I got this loan that's 18%. They're going to tell you to go fuck yourself, dude. I'm sorry, and not to mention you have other competitors that you have to compete with that may not necessarily be in such a like, what's the word? In such a precarious position, who can outcompete you now because they can offer loans at 10% or at 12%, right?
Sure.
Yeah.
But since we were public back in Q2 of 2020, our interest rate that we were giving out has gone up by 1.8%. But yet our delinquency rates have gone up by 0.8%. So we're actually making more on our loans now in a worse environment than we did back in whenever we first went public.
Brother, this is not a worse environment than when you guys went public. Not at all. Trust me.
So yeah. It at any period in time since we've been public, how about that? We've charged more on our interest rate per quarter then our delinquency rate has gone up. So
yeah, but the total volume, but you guys didn't have that total volume of personal loans, right? You were mostly doing student loans at the time. Right now, the shift has been to personal loans. Personal loans, as we know, are not that great. If delinquencies shoot up, you got a problem, right?
Yeah, but I'm saying the delinquency rate doesn't matter if someone is willing to take the interest rate that is higher. So and they are taking it. So you can say they won't take it, but they've gone up by 1.8% and delinquency rates have only gone up by 0.8%.
I don't know, man. I'm like I said, we're looking backwards at something that we should be looking forwards, right? Right now, their business is very, very reliant on these personal loans with the delinquency rates at super all-time lows. If that delinquency rate starts to climb, we got problems. I'm not, by the way, I know someone's like, oh, why the hell is he smiling? The reason why I'm smiling is because I'm at a point where I'm trying to understand what kind of borrower who has a high net worth or who has high income goes and gets a personal loan. Like the minute, if I'm a high net worth individual, me and my wife, we make over a certain amount of time, we actually would qualify as the target audience for SoFi. But the minute you tell me that, hey, it's a 12% APR, I would be like, what?
My biggest disconnect is that either people are buying these loans. We're seeing not only more people buying the loans, but more people on a percentage basis quarter over quarter buying the loans than ever before. So it's growing faster and faster every single quarter. So people are buying the loans. So you either have to take a position of they're cooking the books or
you got a ton of consumers or a ton of consumers are in bad positions in life. And that means that they're doing everything possible to get a loan so that they can weather the storm. Because if you look at the other thing, which is how much credit has gone up, look at the amount of credit. Like, I have to look it up on the Fed's website, but basically credit utilization has been skyrocketing, right? Savings rates have been dropping. Credit has been skyrocketing. So if you think about it, most of the people that are probably getting these loans right now, they have no choice. They're like, listen, I need this money just to survive. But at the end of the day, if their economic situation does not improve, they could just declare bankruptcy. And now the entire balance goes on SoFi's books. The one good thing is that the loans are not like crazy amounts. Like the total loans that they give on a per person basis is actually relatively small. Like imagine right now. Yeah.
I have the number. I'm wondering because I thought they were pretty sizable. I mean, it's only a personal loan, right? But $24,770 a loan.
Right. That's not that bad, believe it or not, considering that if you look at like a mortgage,
It's no home
which
loan.
if you look at a home loan, the thing is, when you have like something like 24,000 and this many you have a lot of diversification. So unlike the mortgage side, where let's say you give out a $500,000 loan, they're only giving out 24. So which means that now you have a lot more people have to pretty much go default in order to be on the same risk level as someone who was issued a $500,000 loan. The difference is the person with a $500,000, let's say home loan, there's an asset that's backing it. There's the actual home, there's the property. It's based on just credit.
Yeah, I think there's no difference between a secured loan versus an unsecured loan if the interest rates are going to be high enough to pay for the collateralization. So, like, we still have to take on the house.
Say that one more time. There's no difference between a secured loan versus a
because either we take a secured loan at 4% right now on home loans, or we take a unsecured loan at 12.2%.
Yeah, but the risk
makeup of the difference in the loan is our security.
But see, that's what I'm trying to understand. The rate at which these things default is really bad. It's really high, and especially in economic times like this, it gets really bad. I understand what you're saying, that hey, higher the risk, higher the reward, right? You're taking more risk because you're issuing a personal loan, which means that yes, you are allowed to charge 12.5% for a personal loan. But all of that stuff is going to be meaningless if there's massive defaults. That's all I'm saying. So once again, I gotta go, guys. But look, I love your SoFi content, but just be more skeptical. That's all I'm saying. I do want to say that Anthony Noto, out of all the people that I've listened to when it comes to running a company, the guy seems to have a good head on his shoulders. He knows what's going on. He knows what he's doing. My only thing is he is in a position where he's got to figure out how to weather the storm, because every company right now is trying to figure out how to weather the storm. So I think comments from Anthony Noto in the next quarter, next earnings, are going to be a telling sign where SoFi is headed. So yeah, and it's the same thing with a lot of companies right now. Good CEOs will figure out how to weather the storm and come out stronger. Terrible CEOs will sell their stock, tell you to go fuck yourself and declare bankruptcy, Chapter 11. And that's all she wrote. That's all.
Sure. Yeah.
Kris, really,
I think that's a great point for, what we did exactly whenever, student loans went under. We pivoted and found a way to continue going.
Exactly. If that's the example that you want to use, that's perfect right there. You need to have people that pivot. Like right now, I'll just finish up before I go. Like Open Door right now. Open Door, you see Eric Wu, he's been selling, right? Like literally just selling. He's not one bit, hasn't been a single transaction where he's buying. Also, Open Door is sitting on all these properties, but guess what? They need to shift. They need to start working out a way that they can actually make money. Otherwise, they're going to be insolvent. So all I'm saying is, at least with Anthony Noto, you have a guy who supposedly can execute, and he's shown in the past that he knows and he can pivot. But you don't want a rigid CEO who's like, I know best and no one else can challenge me.
You mean like Alex Karp?
Shut up.
Kris,
that's all.
Kris,
yeah.
I think all the points you brought up were fairly solid, and I'm definitely going to go take it back and do some homework. But I know you did a good job as a bear when the moment you came on, and until now, the chat has just been fucking arguing back and forth.
Bro, there's some people who are like, if you can't listen to Kris, you shouldn't be in the chat. Like, Kris is good. The other people are like, hey, Kris, don't let the door hit you on the way out when you leave.
The reason why I don't like, that's why when you guys said, oh, come on the chat, that's why I didn't like, because I'm a very controversial figure. Either you'll agree with me or you won't, but I'm great for content. I'm definitely a bomb thrower.
If you got to come onto my channel, and we can argue it out on a couple of other points. Because
I need more haters. Please send more haters my way. I don't get enough Twitter DMs telling me to go fuck myself in the Palantir.
All publicity is good publicity.
No, it's not. No, it's not. All right. See you guys.
See you, man.
Thanks, Kris.